In this segment you will learn loan payment variables and how to calculate mortgage, auto, and other payments. One of the most powerful tools you can have when you go to an auto dealership or when you go to a bank is knowing how much you can afford before you go there. The power of a spreadsheet allows you to do that, allows you to figure out how much can I afford, what do I want to take on in the way of responsibility for making these payments. I've set up in front of us a spreadsheet that's got some of these variables in them. I've just labeled it generically a loan payment, and this one really speaks to an auto payment. I've stuck in a principal amount, a car value amount of $36,000, a term in months of 48, an interest rate expressed annually as 6%. What I want to calculate is my payment. In calculating payments, you need 3 out of these 4 variables. If you have a payment, you can back into one of the other 4. In this case, let me see how much of a payment would result using these variables. I go up to my function wizard, I insert a function, and I get a table. I want financial, and I want to go down to payment. If I get down to payment, click on it, this one says you need variables of rate, number of periods, present value, future value, type. Calculates the payment for a loan based on constant payments and a constant interest rate. Okay, that seems right. Let's click on OK. And what it does, it asks you for the arguments. You'll notice these first 3 are bolded. What that means is you need 3 out of these 4 arguments to complete. Rate. My rate is 6% annualized. Now I've got to make it and my term equal, so I'm going to say G8 divided by 12 gets me down to a monthly rate. You see it's a 0.05 in this case. Number of periods, I click on it with my mouse, it's going to be 48 periods. That's G7. Present value, $36,000. What happens here is that we are computing a payment. At the end of a 48-month period, our future value should be 0, so we can let it blank at this point. The type refers to when the payment's made, beginning of the period or end of the period. Most of the loans you'll deal with are the payment being at the end of the period, so we'll leave it blank and hit OK and see what happens. In this case, we will owe on a monthly basis, which is why it's stated in red, a cash outflow $845. Now we can determine, is that something we can afford? If you don't like that negative sitting there, which I don't particularly like, you can go up pretty much anywhere in this formula. I'll stick a negative sign right before the P, and it'll flip that around so that it's a positive, if you will, $845. Because I've built this in a table, and because all of these are cell references, I can change them and say, well, I like the car at $36,000, but I can't afford $845. If I go up to 60 months, it'll go down to $695, except that the rate is going to go up to 0.0625. It's $700 a month. That may or may not be within my monthly budget. Well, let me reduce the car itself down to $30,000. Now I'm down to $583. The power of the formulas is that before you go to the dealership, while you're still searching for the car, you can say, I can afford this or I cannot afford this. This is part of the power of a spreadsheet. This concludes the segment on calculating loan payments.